our session, but this 1 hour will really be very helpful for those of you guys who are revising. And I would want to connect what we did in our last class, this Hamada's model, with what we shall be doing today. And for that reason, I would want us to look at just one part of this question. Yeah, that is April 2025, question number 5A. April 2025, question number 5A. April. Question number 5A. Question number 5A. Once you get the question, can you kindly say yes? Like this live, like a ninja. And you have to be very happy. You must be very happy because where it has reached, seated somewhere, holding your cheeks like this, like you have, a bad situation. No, we shall be cheerful. We shall be happy. Evans has already gotten it. Jay has gotten it. So we read Jawabu Limited is a 100% equity financed company. The company is considering undertaking a major diversification in the consumer electronics industry. Its current equity beta is 1.2, while the average equity beta of electronics industry, where this Jawabu company wants to go to, is 1.6. Gearing in the electronics industry averages 30% and 70% equity. Corporate debt is considered risk-free. Additional information, expected return on the market is 25%, risk-free is 10%, corporation tax is 30%. Using suitable discount rate for the new investment, determine wakaka. So in this particular question, where do you think shall we begin attacking it from? Ninja. Hamadas, okay. We get Bell. Getting Bell. Are you sure? Is that what I taught you? I doubt. At least Birech is coming near there. Anigia the industry. Anigia the new industry. So give us Bell for the industry. Are you able to see Bell for the industry? It's going to electronics industry. So I can't pick Bell of the older company, of Jawabu. It has to be Bell. It has to be Bell of electronics industry because first we ungear the new industry. So I'm being given 1.6. So how about debt to equity ratio of new industry? Or at times in this case, they could give you debt separately, equity separately, no problem for the new industry. So you can see it's electronics industry and they have given us 30% debt. 30% debt. And then of course, equity is 70%. So then in this case, you want to ungear, ungearing, we're using the Bell, the Hamada's formula, which will be Beu into 1 plus D over E into 1 minus T like that. So now we have everything. Remember, this must be beta equity of a levered organization. Why levered? Because you can see this industry, it has debt already. So then Bell will be equal to Beu into 1 plus D over E into 1 minus T. And the Bell is given. The Bell is given as 1.6, which will be equal to Beu, into 1 plus D over E. So debt is 30 over equity of 70. I can put them as 0.3, 0.7, or even with percent, but I know the percentage will cancel out. All right. So then are you able to see, ladies and gentlemen, 1 minus tax? 1 minus tax in this case here will be 0. What here, somebody? 0.7. To avoid confusion, 30% is the same as 0.3, yeah? This is the same as 0. To avoid confusion, let's just put this as 0.3. To avoid confusion, to be consistent in everything that you're doing. So can somebody, in this particular case, ladies and gentlemen, go ahead and give me what we have in brackets? So is there somebody who can punch this in their calculators? You say 1 plus 0.3 over 0.7 times 0.7. Ruth J is giving me 1.3. Meaning that BEU will be equal to 1.6 over 1.3. 5.33, I doubt. 1.23. 1.23. Thank you so much. 2 decimal places. So we have been able to gear the new industry. We always use what we call the funnel approach. For those of you who have ever done some theses, you normally start with international studies when you're doing literature review. Come to your country, study if it's a high-level research. Go to your county, so a funnel. So you start from the industry, and then now you go down like that. So then having geared like this, what do you think in this case here will be the next issue to take on? Find KEL using CAPM? No. No. Remember, this is not APV. And once you know how to differentiate APV with this, then you will be very good. Yeah, so this is a normal question. So in this case here, after we ungear the new industry, now we are going to put the gear back. So in this, not KEU. KEU, that is automatically APV. We don't talk of KEU here. Yeah, we want KEL, but before we get KEL, you must gear. So you gear the above using my company. You can write like that. Gear the above BEU using my company's information. Gear the above BEU. Gear up. The above BEU using my company's, just own it up like that, information. So in short, what those students are saying is right. Get BEL. Get BEL. That's what they want. Get BEL for my company. Again, you're using Hamada's model. So we know that BEL will be BEU into 1 plus D over E into 1 minus tax, like that. So now we want to get BEL. So what are we gearing up? The above BEU, the one you've got, into 1 plus debt over tax. So remember, we are doing Roman 1. So Roman 1 of this question, ladies and gentlemen, they have given me the debt to equity. So Roman 1, if you required, using suitable discount rate for the new investment, determine the WACC assuming Jawabu Limited, my company's capital structure. So Roman 1, you can see debt is 20%, equity is 80%. So 0.2, 0.8. Of course, this 0.7 remains because tax has been given to us as 30%. So then we have 0.7 like that. So then is there somebody who is able to give us this BEL? So remember, you gear up the above BEU using my company's information. Actually, I should have said using my company's debt equity ratio. That is the only thing I need. That is the only thing I need. And I can see guys giving me 1.45. Thank you so much. Thank you so much. You can see this is an ACCA question that was lifted word by word, which is very, very good. So BEL, I'm being given a figure of 1.45 like that. So having gotten BEL, what do you think will be the next thing to enable me get Wakaka that I should do? Yeah, KEL. is the natural partner of Bell. So get KEL using CAPM. So get KEL using CAPM. Cost of equity of a levered firm. And the KEL will be risk-free into ERM minus risk-free into beta equity levered. Beta equity levered into beta equity levered into beta equity levered. So then if I follow this, my good students, this is what I shall be able to get as my KEL. So my risk-free, have they given me risk-free in this question? 10%, isn't it? And I feel that there is a class that has not received our link. I don't know why I have that feeling. The early morning students, the 5 a.m. students, are we here? I'm just suspecting that maybe they haven't gotten the link. Or they are here, eh? Okay, how about the evening students? We can't be 1:30. This should be a very big class. Evening students, are we here? Of course, I've seen Lincoln, eh? All right. And I believe my physical class students at Commonwealth, they are also around. They should be around. They should be around. Evening, how about physical? If physical students are around, please mention their physical. Anybody from physical who is around? There must be a link that has not been sent. Physical, great. IV, great. So then ERM, ladies and gentlemen, ERM, ERM, actually that also, yeah, that is given in note 1. No. No. You can't use any other method. It has to be just this method. This method. So ERM has been given to us. Expected return on the market is 25%. Minus risk-free, which is 10%, multiplied by Bell that we just found up here, which is 1.45, like that. So Chelsea Person is giving me 31.75%. Yeah. Now, having gotten KEL, now we have everything to give this examiner the famous Walker curve. Now you can give this examiner the famous Walker curve, weighted average cost of capital, which is weight of equity, cost of equity, weight of debt, cost of debt, into 1 minus tax. So the weight of equity, are you able to see the weight of equity in this question? 0.8. Weight of equity 0.8. Are you able to see it? I mean, it's the equity percentage, 80%, right? Yeah. Cost of equity, are we able to see the cost of, it's what you guys have given me here, 31.75%. Weight of debt, we have it. It is 0.2. How about cost of debt? Can somebody tell me the cost of debt? Can somebody tell me the cost of debt? Cost of debt is the same as risk-free, yes. Same as risk-free, yes. So we have here 10%. Because they've told us debt is secure, risk-free. So 10% multiplied by 0.7, 0.7 being the 1 minus taxation. So then we are able to get IVR 10% risk-free. 10% risk-free. Ivy, please tell your colleagues in the physical classroom that they need to join this. This is very, very important. This is very, very important. Yeah, so in this case here, Alfred, 26.8, eh? All right. So you're getting 26.8%. Thank you so much. Let me ask you guys a question. If they brought this question, yeah, in your exam sitting before we did it today, do you think in this case here you would have gotten it right? If they were to test you in this. Oh, great. But then I saw at the very beginning, you guys were confusing this with APV. I saw somewhere somebody saying get KU, because those KU, those are things of what year? APV. And I know when you see an APV question, there is an acronym that I taught you. Are you able to remember that acronym that I taught you whenever you see? Yes and no. Yeah. DRCFA. DRCFA. Great. So then Roman 2, do I give you 3 minutes to try Roman 2? Or in this case here, do I go ahead and do it? Roman 2, 30% debt and 70% equity. And Regia, going to use Bill. But I believe now, Faith, Audi, now you are okay now moving forward. Now you should be okay moving forward. Stand for or the DRCFA. Can somebody remind this great lady, what does that DRCFA? And Faith will be very, very important you get that video. It's a video that we did, Faith. If you miss a class that we're teaching this time around, ensure you watch that video immediately. So Roman 2. You're in class, then you must have forgotten the DRCFA. Not Faith Audi. There is another Faith who has asked me to explain what this DRCFA means. Okay. All right. Now we are doing Roman 2. Roman 2. So Roman 2, in this case here, they are going for a different debt to equity, a different debt to equity, a different debt to equity for my new firm called Jawabu. So not a problem. I will always start from the very first. Yeah, you degear. So the first thing is to degear. That is the first thing you do. You degear the industry. And fortunately, we have been able to degear this industry above. Degearing the industry, we were able to get a degeared beta of how much? Beta equity unlevered. Is there somebody who can remind us? And in an exam, there is no problem. You can still do the degearing. Yeah, from start, no problem. 1.23. This we have already done. Then go to my company. My company's, in this case here, debt stroke equity ratio. Do I have it? I don't have it, but I know the debt. I know the debt is how much? From Roman 2 now. From Roman 2. My company's information. Yeah, 30%, so 0.3. And I know equity is 0.7, isn't it? 0.7. Is there somebody who is able to see that this is exactly identical to the new industry? Anybody who is able to see that? Because the new industry we started with up there had 30% debt and 70% equity. So if they're identical, then what in this case here will you be able to write down here very fast? What do you think in this case should you be able to write down very fast because of that industry being identical to my company? The bell will be 1.6 years. The bell will be 1.6 when you are gearing up. Yeah. So in this case here, in gearing up, we are now gearing up. Yeah. You can come and say if you wish, bell equals BEU into 1 plus D over E. Let's just do it the longer way. So then bell will be equal to BEU, which is 1.23 into 1 plus debt, 0.3, 0.7 into 0.7. So of course, this and this will cancel out, giving me bell of 1.23 times 1.3, which approximately will be 1 point what here? Approximately, because of rounding off errors, approximately this will be 1.6. So I would have omitted this step, if I remember that this structure is the same as the structure of the industry. So that the bell of the company and the bell of the industry will be the same. So go ahead and give us CAL. So CAL using CAPM. CAL using CAPM, which is risk-free plus ERM minus risk-free multiplied by bell. So risk-free, you guys gave me a figure of 10%. ERM, you gave me 25%, minus 10% times 1.6. So and they're giving me a figure of 34%. They're giving me a figure of 34%. They're giving me a figure of 34%. So after that, Catherine, thank you. Are you able to give me the wakaka now? Are you able to give me the wakaka? Are you able to give me the wakaka? You have everything really for wakaka. You have everything really for wakaka. You have everything. So then our wakaka will be weight of equity, cost of equity, weight of debt, cost of debt into 1 minus t. Weight of equity, we have it, 0.3, 0.7, I mean. Cost of equity, you've just given it to me as 34%. So weight of debt, we also have it. Weight of debt, we also have it. It is 0.3. Cost of debt, we got it as 10%. Risk-free times 0.7. Which somebody is able to tell me, ladies and gentlemen, that the final answer is supposed to be 25.9%. 25.9%. So then between the two capital structures that we have, which capital structure is better? Is it the 30, 70, or the 2080? Which capital structure is better? Remember, the better capital structure will be the one that minimizes WACC. The one that minimizes WACC. So if I'm told to pick the better capital structure, as a finance manager, I know my role will be to minimize WACC. My role will be to minimize WACC. So are we okay up to there, ladies and gentlemen? Great. Thank you so much. Don't let me down. Don't let me down. Don't let me down. When this paper is brought your way, ensure that you are able to please yourself and your teacher. And ensure you are able to please yourself and your teacher. Do we start with a new company, really? Can somebody help me answer, Peter? Do we start with a new company? How do we start this thing? The industry. You de-gear the industry. So, Peter, I believe I've been able to move slowly. You'll be able to watch this video later. Yeah, not the new company. Because you see, or rather you are talking over maybe new industry. New industry. The new industry you're going to. The new industry you're going to. Yeah, new industry you're going to. Great. I've done it very slowly. I believe you'll be able to follow. Great. Now, ladies and gentlemen, from there we go to some funny questions. There are questions that whenever I see cast and upsetting, at times I sympathize with the students. Fortunately, this semester, such questions will not be there. This semester, you guys will have a very easy ride, especially if you are reading and looking at what we are doing in class. You'll have a very easy ride. Look at April 2025, question number 2B. 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 Once you get it, please say Y for yes. Thank you so much. So it looks a very, very little question, too tiny. A financial manager has the following bond portfolios. So we have bonds A to C. We have the respective prices. They've given us the yields. They've given us par amounts owed. Then we have durations there. So they want us to give them the bond portfolio duration. This question, not many students were able to do this question totally. When you look at the bonds given there, what do you think in this case here will be the par value of these bonds? What do you think will be the par value? Because par value is missing. Par value is missing. So remember, for bonds, in most cases, the par value, just like preference shares, whenever they are silent, their par value will be 100. Yeah, use a par value of 100. But should you get figures like 800, 1,000 and something, then you use 1,000. But most of the questions, par value is 100. So then what a good student did in this question here, the only thing you need to do here basically is to get the weights for us. Give us the proportions for us. The market value weights. Give us the market value weights. So what a good student did, we have here A, B, C. We have in this case here, ladies and gentlemen, they have given us the capital, yeah, the capital, yeah, total capital, yeah, like the share capital, yeah, so call it bond capital. So the bond capital, I can see the bond capital given there very well. So we have here 4, 5, and 3. So we have 4, 5, and 3, like that. They're in millions. You can even return them there if you wish. But there's no harm if you don't return them. Yeah. And then, of course, we know that one bond has a par value of 100, regardless of which bond. Par value of 100. In this semester, students who assumed even 1,000, no worries. Whatever you assume, no worries. But par value, whenever you see the figures, the price there is 120, 85.5, 130.5. For sure, this one here, the par value can only be what here? 100. It's quite close to the numbers that we have. All right. So then in this case here, is there somebody who is able to give me the number of bonds? What do you do to get the number of bonds? You'll take this bond total capital, you divide by the par value. You take the bond capital, just like number of shares. How do we get number of shares? We normally take share capital. If you remember, what is in the balance sheet? You divide by par value. Yeah. So number of bonds, is there somebody who can give me these bonds pretty fast? Please help me. I know you're not following, but just help me. Help me. So you divide these two. You divide like that. Please help Mwalimu. So number of bonds. So the first one I'm being told is 40K. How about the second one? 50K. How about the third one? I suppose 30K, isn't it? So I want their market prices. Give us the market prices here. The market price per bond. These market prices are given at the very corner there. Bond ABC, you can see the prices. So we have here 120. We have here 85.50. Then we have 130.5, like that. So could you kindly give me the total market value? Total market value. So please come here and give me the total market value, and then I'll be able to show you something. Total market value. Come here and give me the total market value. So then this will be 40,000 times. Somebody give me these answers very fast. I know they're ugly figures, but we shall overcome. So according to Birechi, we have 4.8 million, right? Is it 4.8? 4.8 million. The first one is 4.8 million. How about the second one? How about the second one? 4.8, no. The second one, 42,750. 42,75,000. Thank you so much. And then the last one. The last one. We are being given 39,15,000. 39,15,000. So please give me the total. Add the 3. Add the 3. Add the 3. Thanks, Lincoln. 12,990,000. So then could you kindly tell me I know you are not following very, very well, but we shall overcome. But what do you think will be the next thing to be done after getting this? What do you think will be the next thing to be done after getting this total market value? Thank you so much. We shall get the weights now. We get the weights, yes. So come here, I would have wished to continue with that table, but my board is not very, very big. So A, B, C. So now give me what we call the market weights. Give me the market weights. So market weights will be 4.8 million divided by 12,990,000. This is 42,75,000 divided by 12,000. The last one is 39,15,000 divided by 12,990,000. So then are you able to give me these figures? Then I'll be able to show you a shortcut. Lincoln already has these weights, 2 decimal places. So Lincoln is giving me 0.37. The second one. The second one, 0.33. And then the third one, 0.3, I'm told. 0.3 like that. Approximately, isn't it? Yeah, and then they want in this case here what we call portfolio duration. So they want in this case here what we call portfolio duration. So portfolio duration, you know, portfolio is a combination. So this will be the weighted duration. So then these one, ladies and gentlemen, in this case here, what we shall do, we shall take here all the weights, multiplied by the respective durations like that. All the weights multiplied by the respective durations, and then you add. So that means you take the weight of A times duration of A, plus weight of B times duration of B, plus weight of C times duration of C, like that. So the weights already, we have them. So we have this as 0.37 times the duration of A. Is there somebody who is able to see the duration of A somewhere there? Duration of A is 3 point. We am alone, but I will overcome. 3.86, yeah. Plus weight of B, because you see a portfolio is a combination. The investor has combined the three. So 0.33 times duration of B. Duration of B is 8.05. Plus weight of C. Weight of C, ladies and gentlemen, we already have it there as 0.3 times duration of C. So duration of C there is 9.17, like that. So is there somebody who is able to give us this combined? No. Duration, you know what they want? They don't want the average return. What they want here is the bond portfolio duration. Of course, you can use the same concept of returns. Yeah, the way you take return times. But you see now this duration. So Barbara is getting 6.84. This could be years or something. 6.84 years. So and as an investor, then you know that this is the average maturity period of your bond. Average maturity period of the bond. Average maturity period of the bond. Yeah, and actually they told us to interpret in Roman 2. So please allow me just 1 minute. I do an interpretation to this thing in a way that everybody then will be very, very comfortable. But first of all, before I start repeating, all of us, have we been able to write up to here? All of us, have we been able to write up to here? Yes. Thank you so much. So let me repeat here something very crucial. So that thing of introducing par value in between confuses students. In this kind of a question, you don't have to introduce par value whatsoever. No. You don't have to introduce par value whatsoever. No. So we have here ABC. So these ninjas, they have given me the price. So the price here is 120. 120. We have 85.5. We have in this case here 130.5. They've given me the par amounts in shillings millions. Par amounts. So par amounts, I can see it's 453. So we have 453. So a good student who did go to this FM, yeah, very well, the intermediate level, will tell you if these are market prices and you want to get market weights, you go ahead and multiply this directly the way they are. Even if these are what here? Shillings. Even if these are shillings, it will be shilling times shilling. Just multiply directly to get what we call the market value weights. So can somebody in this case here do the multiplications for me? Like 120 times 4, how much are we getting there? Somebody please help me. 120 times 4, so that gives me 480. 480, 85.5 times 5. So we have 427.5. So we have 427.5, and then we have 130, 130.5. Use the other room. Shall we clear? All right. So 130.5. So this gives us 391.5. Now, please listen. Come and give me the total. Can somebody add the total for us? Please add the total for us. Add the total, add the total. So in this particular case, I'm being given 12.99, isn't it? 12.99. So when I'm getting the proportions, that I'm dividing here to get, that 100 which was supposed to be everywhere will cancel out, will fizzle out. So is there somebody who is able to give me these weights here pretty fast? Two decimal places. So 0.37, I'm told. Yeah. Then come to this one. 0.33, thanks Ruth J. Are you realizing they're the same? Yeah, and then you can come and write duration. You can come and write duration here. So duration is 3.86. 3.86. So we have here 8.05. Then we have in this case here 9.17. You can even create another column here for weights and durations where you multiply, or you simply come and give us what we call portfolio duration. So portfolio duration here, now we have the weights. You simply take the first weight like a probability times 3.86 plus 0.33 times 8.05 plus 0.3 times 9.17. So when CASNEB sets this kind of a question, does it mean that CASNEB at times it's hell-bent to ensure that students simply fail? Because it doesn't look tough. Yeah, and that's why at times you will get some students who will call you and ask you, Mwalimu, these questions, when I got the paper like this, I went through the whole paper and even smiled. But when it came to that position where the rubber meets the road, grring, I could not write anything. Only sweat. All right? Because the question, when you look at it like this, it looks really, really, yeah, it looks very, very easy when you look, but start doing it. This time around, no sweating. Thank you so much. Now, as we speak, is there any student who could have tried, or rather who did this April 2025 exam? And in that exam sitting, they never knew even that this question, this is what was expected. Any student who sat for this paper on this particular sitting? Oh. This question, the same question that Mwalimu has done, this question that I've done, is there somebody who did this question? In CASNEB, yeah, amongst, okay. We shall overcome. We shall overcome. Don't worry. Yeah. Great. So I believe if they should, if they bring this kind of a concept now, you'll be able to use this shortcut and ensure that you are able to use this shortcut approach to nail it down. All right. So we go to April 2025, question number 4B. April 2025, question number 4B. April, question number 4B. So now in my next lesson, I will ensure that I do leases. I see so many of you. Yeah, that 10% yield is just kept there to confuse you. Yeah, go to relax. Let's do what Mwalimu wants you to do. Now you can see now students have started running to the topics they want. Let's do what Mwalimu wants us to do. Let's focus here. We are focusing with this. All right. So question number 4, boy. The table below shows that at the end of the year's levels of the price of an ordinary share in Tausi Limited and a representative stock exchange index. So you can see the years, you can see Tausi Limited's share price, you can see stock exchange index, which is our market. The risk-free rate is 5%. Expected return from the entity, from the equities, is 8% per annum. All right. Now, ladies and gentlemen, when you get this kind of a question, then what shall you be able to do? They want us to give them the beta coefficient of Tausi Limited's ordinary shares. You see, you can see the return here is given in Kenya shillings. The first thing that you need to do is to change that return into, not KPM here. You need to change that return into a percentage. So we have here, so 2019. If you don't do that, you get 0 in the entire question. So returns of Tausi ndege wangu. And then we have returns of the stock exchange. Yeah. So then we have here 76.5, 85, we have 79, 81, 78, 75. So this is 795, 900, we have 840, we have 875, we have 815.5, then we have lastly there 752. So I want to change this. I want to change this into percentage returns. Is there somebody who is able to remember our shortcut? April 2025, question number 4B, yes. Anybody who is able to remember a shortcut for us to do this? New minus old? Yeah, but that's not a very easy method. Take you a long time. Remember this one of Pn? Yeah, over Po minus 1. Pn over Po minus 1. So like the first years will not have anything, eh? The first year is nothing really. Same case here. But when you come to this is the most recent. So you'll do 78. I can even use this one here. So you say 78 over the old one. Whatever we get, we say minus 1. Whatever you get, you say minus 1. You know, there are two ways here. Eh? Somebody can come and tell you, Mwalimu, the better method for getting the percentage return that take new minus old over old. So the new here is 78. If I'm looking at the 2 years only, minus the old, which is 75, all over the very old. Whatever we get times 100, isn't it? Whatever we get times 100. Is there somebody who is able to give me this answer? Somebody please give me this answer. 3 divided by 75 times 100. I'm being given 4%, isn't it? I'm being given 4%. But what if you used this other better, prettier method? Yeah, where you take the most recent price divided by last year's price, minus 1. So in this case, then I will talk of 78 over 75, whatever I get, minus 1. Are you able to get, in this case here, the same answer? Yeah, yeah. So let's get, in this case here, all this together. Let's get all this together, ladies and gentlemen. Let's now get all this together. So we start with this one, 78. Yeah, so in this case here, 78 over 75. This one I've been told it's 4%. It's given here percentage. So whatever you get, and show you multiply by 100. What about this one here, somebody? I'll talk of what, divided by what? This 81, I'll talk of 81 divided by what? Yeah, 81 over the immediate predecessor, which is 78. Whatever answer I get, I say minus 1. So first of all, I take 81 divided by 79 equals, whatever answer I get, I say minus 1. And then I say equals, yeah, 3.88%. I'm being given a figure of 3.88%. So for me, I can come and create another column here where I will be able to capture my returns. Yeah, returns for tau C in percent. So the first one, of course, is not there. The second one is 4. The third one is supposed to be 3.8 who? 3.85. Yeah, then you go to the fourth one. So in this case here, this will be 79 over the immediate predecessor. So 79 over 81. So first of all, I say 79 over 81. Whatever answer I get, I say in this case here, minus 1. Minus 1. So please always try to help Mwalimu answer the questions. Because remember, in portfolio theory, yeah, we shall upload, yes. In portfolio theory, all our returns must be in form of what year? Percentage. That is a rule, purity. If you do it in Kenya shillings, you get a 0. That one will be giving, in this case here, the marker, a quite fast Christmas party. Yeah, of earning, in this case here, lots of monies without working. All right. So in this case, what do we have? Ladies and gentlemen, give me the figures now. Give me the figures now. Now I want the answers now. Not unless somebody is not able to get to them. Please give me the answers. The next one after 3, minus 2.47, right? So minus 2.47, and then I don't have to write the percentage because it is up here. Yeah. And then from there, ladies and gentlemen, we have here 900, not 900, but 85. Yeah. You guys do your bracadabras. So I'm getting, in this case here, 7.59. 7.59. Thank you so much. Then lastly, I'm getting minus what here, somebody? 10%? Minus 10, like that. Minus 10. So could you then kindly, these are returns in Kenya shillings. How do you get these returns in percentage? Returns for S in percentage. How do we get them? Very easy. How do we get these ones? Very easy. Very easy, very easy. So to get the returns of this stock exchange, of course, the first one will always be dashed because this is where we are starting from. To get the next return, what I will do is to take this number, 815.5, I divide by 752. And then whatever I get, I say minus 1 times 100. Is there somebody who is able to give me these figures? So you take the most recent PN over PO minus 1. PN over PO minus 1. So the first one, I'm being given a figure of 8.44%. 8.44%. It's a growth rate. So to see how this number is growing, this number here, how is it growing? You take the number itself, divided by last year's number, minus 1. So you take this number, divided by this number equals whatever you get, minus 1, I mean. Yeah. And then, of course, you multiply with 100 because I want percentage returns. I want percentage returns. I want percentage returns. We're almost finishing. We're almost finishing. 7.29, 7.3. I'm being given a 7.3 here. 7.30. So is there somebody who can just finish now getting all of them? Somebody who may easily get all of them. Minus 4, right? I'm being given minus 4. Thank you so much. Minus 4. Thank you so much. Again, 7.14. Lincoln minus 11.67, like that. So very many students in this sitting were not able to do this. Many students in this sitting were not able to convert the Kenya shillings returns to percentage returns. Now, once you finish that, what I would want you to do pretty fast is to come and give me the RT here and the RS alone. Yeah, don't start with the dashes. Now we have 4, 3.85 minus 2.47, 7.59 minus 10. Then we have 8.44, 7.3 minus 4, 7.14 minus 11.67. So then I want us to get expected returns of T. Expected returns of T. Stock exchange index. Yeah, well, once we reach there, for now, just call it S, stock exchange index for now. But once we reach there, you're right, it will be our ERM. It will be our ERM. So Stephen has been able to add all of them. So summation, so I want to get expected return of T. Yeah, which will be the summations of returns of T over N. So is there somebody who is able to give me the expected return of T first? Don't divide by N minus 1, no. Already I've removed that. Yeah, don't divide by N minus 1. You divide it by N. So can somebody give me this RT summation? 2.97. So 2.97 you divide by 4 years. 1, 2, 3, 4, 5 years actually. You divide by 5, like that. Divide by 5. So then this one here will end up giving us 0.5 what here? 0.59, 0.594. Thank you so much. How about expected return of our stock exchange? Expected return of our stock exchange, which of course will be our RM. We can change that later. So do the same, yes. So expected return of S will be summation of RS all over N. Yeah. So then can you kindly add for us everything there? Give us the summations of RS. 7.21. So 7.21 all over 5, which will end up giving us what figure? 1.442. Now read the question then. What do they want us to do? Number 1, they want us to give them the beta coefficient of Tausi Limited's what year? Shares. N, number of years, 1, 2, 3, 4, 5. Number of years. So they want us to give them beta coefficient of Tausi's Limited. So to get beta, let's just go ahead and change. You know, our stock exchange is our market, because they have asked for beta there. This is our market. So meaning that this will be market. Please change. Change like that. Change everything to S, S to M, like that. So is there somebody who is able to give us the formula for getting beta of a security T? How do we get beta of security T? Beta of security T. And please here, don't count the very initial year that has dashes. Don't count that. Don't count that. Don't count that. Don't count that. So beta T, somebody who can give me the formula beta T, it will be covariance between T and M. Yeah. All over their respective, all over, in this case here, standard deviation of the market done what here squared. Yeah. You take in this case here covariance between T and M, between the security and the M, you divide by the variance of the market. So then let's go ahead and get the covariance between T and M. Is there somebody who knows the formula for getting covariance between T and M? So covariance between T and M, this will be the deviation of T times deviation of M times probability that we don't have. This question does not have a probability. This question does not have probability. If it doesn't have probability, what are we supposed to do? Now we divide by N minus 1 because we lost a degree of freedom when we estimated the mean. So you divide this. Whenever you don't have, ladies and gentlemen, whenever you don't have probability, to get covariance, you shall divide by n minus 1. And then later on, you guys, you must have done this in class, right? Had you done these things in class? Because mkianza kulia sana inamaanisha tuache kufanya. Because I thought I was to help. Nikiona moto kila mahali, kumaanisha tuachane nayo, because we don't also want to do things that are really heavy. All right? All right. We even did the same question, right? Right? Yeah, deviation over t times deviation over m all over n minus 1. So then how do we get this deviation? So to get this covariance between t and m, the deviation over t, it will be returns of t minus expected returns of t into returns of market minus expected returns of market. N minus 1. So of course, this one here, we must do what here? We must sum. Yeah, so that is covariance, which I would expect that you guys will be able to handle it very, very well. And then now we go straight away, ladies and gentlemen, and do the standard deviation. Is there somebody who is able to remind Mwalimu, how do you normally get standard deviation of the market? So this is the deviation of the market. We're looking at difference between returns of the market. So we have here returns of the market minus expected returns of the market. Yeah. So this, remember, must be in terms of sum of what here? Squared. But we don't have probabilities. I would have multiplied here with probability to make my work easy. So because of that, I will have to come and divide this by n minus 1. And then at the end of the day, we have what here? Square root like that. We have the square root like that. All right. So that is it. So mine was just to open your eyes regarding this situation. If they were to bring a question of this nature without what here, without probabilities, and returns in terms of what here? Kenya shillings. So now from there, I believe you guys now can run with the ball. You can run with the ball. You can run with the ball pretty fast. Is that okay, ladies and gentlemen? Are you able to run with that ball now? If you're to finish, it means you can easily finish. Yeah, it means you can easily finish like that to the very end. And then now the question that I would want you to also be very, very serious about, this is my last one for this one. Yeah, it is this December 2024, question number 2. December 2024, question number 2, B. Question number 2B. Yeah, this one on optimal weights. Don't fail to do this. I'm so sure you have this answer somewhere. December 2024, question number 2B. So that marks the end of our today's session, ladies and gentlemen. Mine is simply to open up your minds. Once I open up your minds like that, when things become a little bit hot, then I leave you to go and cool down as you try to figure out your way. I'm so sure by the time you finish this question and you do this one, you will thank me. Come next week. Sawa sawa. So ng'ang'aneni kabisa. So we shall overcome. So we shall meet tomorrow the same time. And remember, most of you that are asking me, Mwalimu, when are we finishing these classes? It means I've never taught you before. Remember, I normally continue my classes to the point of your satisfaction. When you feel that you are satisfied, what do? Chokipara. Unakamata njia unaacha wengine. Paka nitaanza kubaki na watu 10, watu 5, namna hiyo. So don't expect that this class will be coming to an end anytime soon. You only come here just for about an hour in these subjects, and then that will be it. Sawa sawa. All right. Product screenshot, okay? Great. Please do that. All right, and we are getting very good compliments that other colleges closed long time ago, but Mwalimu, you guys are pushing us as students, which is really, really, really good. We want you to get value for your money. Paka easy exam room, eh? Yeah. So then when I come tomorrow, same time, I'll be looking at what you guys now mentioned there, the leases, and then I'll also be looking at this derivatives thing. Yeah, derivatives thing. So after that, then those who are in a hurry, they can now stop joining classes. But other students in this case shall be able to continue to the very end. Otherwise, thank you very much. See you later. See you later. CPA is very important, yes. Good work. Thank you so much.